Describe the five-step model as specified in IFRS 15. So basically the questions I was asking about the 5 steps now to be followed by an entity whenever now an entity is to recognize the revenue from contract with customers. So let's summarize those particular steps there. Remember, in our case, we are doing the revision. This is the paper for November 2019, and this is a question 3. So we start with part A. Part A, we are required to describe the five step model for recognizing revenue from a contract with customers customers. Now, the first thing which is important here to remember is that this particular standard here, that is IFRS 15, it was issued to replace another standard that is IAS 18, and basically this particular standard here prescribes the principles for recognizing the revenue from a contract with the various customers. And therefore, this particular standard here, other than giving now the principles for recognizing that particular revenue, it has actually given 5 steps, basically which must be followed by an entity for an entity to recognize revenue from contract with customers. And that's what the question was asking. So step number 1, for an entity to recognize a revenue is basically to identify contract or basically contract with the customers the customers. So means that the first step which an entity, or basically the first thing which an entity will need to do for it now to recognize the revenue from a contract with a customer, or basically customers, is to identify a contract or basically contract which have been entered with customers. And basically in this case, according to IFRS 15, for a contract to exist, that is a contract with a customer to exist, there are those particular conditions which need to be fulfilled. One is that that particular contract need to be approved, by all the parties, So that means if, for example, maybe an entity is to supply some goods, or maybe an entity is to provide some services, that contract need to be approved by the business itself, and basically the customer who is to be supplied with those particular goods, or basically to be provided with those particular goods services. 2 is that that particular contract should have commercial. It should have a commercial substance. So basically what this means is that this particular contract, or in this contract between the business entity and the customer, there must be some amount of money which is actually exchanging. So that means that the business should actually supply the goods or provide the services, and then by the end of the day, the business should actually receive some cash. So in that case, we say that there is some commercial good substance. Number 3 is that the payment terms and the payment terms also need to be identified. Also need to be identified. identified. So basically, when we talk about the payment terms, so we are talking of how now the goods or basically services to be supplied or basically to be provided will be paid for, and basically when the payment should be made. So therefore, if at all now all those particular conditions exist, then in such a case we say that a contract exists between now the business and basically a customer. So therefore, the first step here is to identify that particular contract or basically contract with customers. Now, step number 2, according to this particular standard here, is basically to identify the performance obligation, performance obligation. Now, in our case here, when talk about what we refer as the performance obligation, we are talking of what is expected from the business in that particular contract. Usually, in a contract between a business entity and a customer, the obligation or what the business is supposed to do is to supply the goods or basically to provide what? The services. So therefore, in this particular step number 2, the business should be able to identify the services, or the goods, the services or the goods to be provided, that is in case of services, or in case of goods, those goods which are to be supplied. So that is the performance obligation, or basically that is the obligation of the business in that particular good contract. That is the step number 2. Step number 3, we have step 3. Step 3, that was step 2. Step 3 is basically to determine, a business should be able to determine the transaction price, transaction price. Now, in our case, when we talk about the transaction price, we are talking of the amount of money a business expects to receive as a result of supplying some goods, or basically as a result of supplying some good services. So therefore, in this case, when we talk about now the transaction price, we are talking of the amount of money the business expect to receive as a result of performing its contractual obligation, and then from there we have step number 4. Step number 4 is allocation of the transaction price, to the performance obligation, So basically what this particular step entails is that this particular amount of money which is to be received by the business, it should actually be allocated to the performance obligation. What that means is that if, for example, maybe a business is supposed maybe to receive an amount of like 50 million, and maybe assume that this particular 50 million will be received as a result of maybe services which will be provided maybe in year 1, services which will be provided in year 1, year 2, and also in year 3. Now this particular amount here of 50 million then should be allocated to the services which are to be provided in year 1, in year 2, and also in year 3, because what you need to note is that this particular amount of 50 million should not be, for example, be recognized as a revenue in year 1, but rather it should be spread in those 3 years based on when the services are to be provided. And that's why we are saying in step number 3, the business will need now to allocate that particular transaction price to the performance obligation. And then finally, step number 5, because we have said this single 5-step model entails, or basically do have 5 steps. Step number 5 entails recognizing the revenue, when the entity satisfies the performance obligation the performance obligation. So what that means is that in this particular step number 5, for the revenue now to be recognized, it will only be recognized when the entity satisfies now the performance obligation. So basically what that means is using this particular example which I've given here, I've said that if there is a contract between now a business and a customer, and that contract, the business expect to receive an amount of 50 million, and that 50 million will be received in respect to services which will be provided in year 1, year 2, and also in year 3. For the revenue which will be received in year 1 to be recognized in the books of account, then the business should provide the services, should provide those particular services. So that's why we are saying the revenue will only be recognized when the entity satisfy the performance obligation, or basically when the entity has actually provided the services. So therefore, according to this particular standard, that is IFRS 15, for an entity now to recognize revenue from a contract with the customers, then those are basically the 5 steps which need to be followed. So basically, that's what was required in that particular part A of that question, which was having 10 marks. So for each step there, you are supposed to get 2 marks.